please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Okay, so the market's down again, and I think it's got to do with what's happening with the currency. So that a bounce which was visible. I mean, at 11 o'clock, the Nifty had 40 points on it, and after that, it's all been downhill, and it kind of sort of matched the advance on the dollar against the rupee. So 72 plus have been getting you views as far as the currency is concerned. So that's where we are at. I said this in the morning that, after a 250 odd point sell-off on the Nifty, if the market has to recover, it has to recover in some style and substance. It has to be a bigger bounce and not a mere 14, 15 sort of point or 30 point kind of a bounce. It has to be bigger than that for it to sustain or the market to see a bit of a meaningful pullback. Otherwise, usually after a big fall, a very concentrated time period, the next cut is not small. I mean, it could run away on the downside. So let's keep our fingers crossed. Maybe there is still going to be attempted and pullback, and over the next 2 hours or so, we'll see how that kind of pans out. We'll have Ashwani, of course, join us in just a bit to take us through what he's thinking and making of the market. This is Midcap Radar. With me is my colleague Sumaira. Hi, Sumaira.
Hi, Prashant. Good afternoon to you.
Ashwani was just with us, and he's back with us now on the top of the show. Ashwani, thanks very much. Afternoon. You've been sort of firmly of the view that, and I heard you in the morning at open when there was some feeble attempt at a recovery, that this is going down, so get short. Your thoughts now?
See, the issue here is now no longer of support or resistance. We are kind of anchored to the rupee, to the macros, EMs, the currency crisis continues. So unless the rupee starts to stabilize, which means it stops falling, it'll be difficult for the market to hold on. And today the issue is that if you see the bounce from 11,400, after 3 days of slamming, you hardly have a 60-point bounce. This bounce is not going to sustain on the Nifty, and banks, you have an expiry today. My sense is, this downside will accelerate. The problem with the rupee is that the 15 paise move happened hardly in like 5-10 minutes. That means some big, dollar buying happened. So given that, I don't think rupee is stopping at 72, 10, etc. So now 72 becomes a kind of a support. So that way, my sense is that this crisis continues. If the macros continue to weaken, you can go below 11,400. So the idea for people should be to remain short as we go into the close. But definitely some new levels are going to get breached as they have on rupee. So I'll give you the calls again. We are planning to sell Axis Bank with a stop of 635, target of 610. RBL is a sell with a stop of 587, target of 565. And Biocon is a buy with a stop of 635, target of 616.
Ashwani, thanks much for your trading ideas. Let's shift focus then to some M&A activity. Bharti Group, I understand, is looking to exit the future retail setup. CNBC TV18 learns from sources that their subsidiary, Cedar Support Services, has begun talks with a clutch of private equity investors to exit their stake in future retail. Priya Sheth with more details. Priya, what kind of valuations are now being discussed?
Well, absolutely. After selling about 6% stake to Azim Premji-led investment arm Premji Invest, we understand that Bharti Group firm Cedar Support Services is looking at selling about 3.19% stake in future retail. Do remember that this will mark Bharti Group's exit as far as future retail is concerned. Now, let me take you through what we do understand is that they've started talking to several private equity investors, including foreign as well as domestic private equity funds. And the valuation, we understand, could be in the range of about 850 to 900 crore rupees at current market prices, but it could go a tad higher depending on how the valuations move. As far as Future Group is concerned, we do understand that they're likely to receive about 400 to 450 crore rupees as a part of the clawback provision that is part of the the agreement. But of course, the timing of the deal is critical, because we do understand that this deal largely hinges on when a foreign investor buys a stake as far as future retail is concerned. Remember that Amazon and the likes of several global tech giants are eyeing a significant pie, about 10% in future retail. So once that goes through, we do understand that this transaction is likely to go through. And we did reach out to all the companies involved. In fact, Bharti spokesperson said that they do not like to comment as far as market speculation is concerned. And Future Group said that they cannot comment on a deal where the company is neither a buyer or seller.
Priya, thank you very much for that. So we'll await when this transaction finally happens, but this is underway in the works. We move on to another CNBC TV18 exclusive now. We learned from sources that the DG Anti-Profiteering has submitted his report with regards to HUL, that is Hindustan Unilever Limited, and his alleged profiteering of 495 odd crore rupees by the company. Timsy Jaipuria is now joining in with these important details. Timsy.
Well, as you rightly mentioned, DG Anti-Profiteering has submitted its final report on HUL to National Anti-Profiteering Authority, alleging profiteering of 495 crores. DG Anti-Profiteering in its report has also said that HUL profiteered on over 1,600 stock-keeping units, and a first round of hearing between HUL and National Anti-Profiteering Authority has already happened, where HUL has contested the claim and has told National Anti-Profiteering Authority that they had assessed profiteering in advance of about 160 crore rupees, and they have already submitted this amount to DG Anti-Profiteering. However, National Anti-Profiteering is yet to come up with its final order. Normally, it takes there's a process of several rounds of hearing. So, first round of hearing has happened, where HUL has contested the claim, saying that the allegations of anti-profiteering claim by DG Anti-Profiteering of 495 crores is overstated. But yes, DG Anti-Profiteering in their investigation have found out that it was not 160 crores, but it was 495 crores. Meanwhile, when we reached out to HUL company spokesperson told us that during the transitionary period, HUL suo moto offered to pay to the government the benefit it accrued to the company and could not pass it on to the consumers, which was aggregating to amount 160 crores, which included 36 crores on behalf of redistribution stockists. However, they've also said that DG Anti-Profiteering has submitted a report to which they have responded in a comprehensive manner, and they are confident that NA will consider their input on the practices followed by them in the FMCG industry. So let's see what is the final order by National Anti-Profiteering Authority, whether it is in favor of the investigation reports by DG Anti-Profiteering of claiming that HUL profiteered at 495 crore rupees, or it is in favor of HUL. Back to you.
Talk about some buzzing stocks then. In fact, paper stocks have been buzzing. Amongst them is JK Paper. Today is the last day that the stock trades under the ASM framework as well. The added positive is that earlier this week, the Odisha unit has reopened after an 11-day shutdown due to a workers' strike. A.S. Mehta, the president of the company, joins in for the very latest. Mr. Mehta, good afternoon. Thanks much for speaking with us. So first, talking about the Odisha unit, I understand that operations have now resumed. Is there any sort of a time-bound nature to the agreements that have been reached with the workers? I mean, would they impact your financials at all?
The agitation and the so-called strike, it was only by a section of worker, and it was not legal, it was unlawful according to us, because it was called for by a union which was not a recognized union. And so with the intervention of the government and also the dialogue by the Labour Ministry, the Labour Department, they have called off suo moto from their side, and this is how we also lifted the lockout which we declared on 31st. So I think it was a very short duration of the lockout. There is no question of any agreement or something, because already there was a valid agreement which is in force up to 2020, so there is no question of any new agreement. In fact, they have called off suo moto from their side because it was not called for an agitation.
Okay, so in that case, can you give us a sense on outlook in terms of, has there been an increase in paper pulp prices? What's the likely trajectory going forward?
Right. See, in fact, the demand is healthier, and but to my mind, all the product categories, the demand growth is going to be in the range of. To my mind, this year, earlier we were thinking it may be 5 to 7%, but to my mind, it is going to be in the band of 7 to 8% now. The writing and printing paper is going healthy. The growth is very good, I would say. The packaging board is going double digit. It was anticipated also double digit, and to my mind, it may grow further, and the growth may be in the range of 15 to 16%. The coated paper is also growing very well. So all round, all the paper categories where we are present is going very well. So that's one scenario. International pulp prices have been very strong from last 6 months, and they are still strong. Yes, there was some kind of the softening of the pulp prices of around $20 to $30, but that has not impacted the global paper prices. And even if the paper prices comes down by around $20 a ton, but the rupee dollar parity has nullified that impact, because now the dollar at 71.50, so the landed cost of the paper in India is higher than what we are selling in India at the domestic prices. So the prices scenario is also favorable to the industry.
So, I mean, imports are not as competitive now anymore, which is great news for local players, right? I mean, there are no exports here, right,
yes,
sir?
Yes.
Just to clarify.
No export is there. In fact, there are a number of players who are exporting. I mean, we also export something around 7 to 8% of our production. And in fact, we are exporting. There are two reasons. One is that we have imported our machineries under the EPCG scheme. So I have an export obligation. So I need to do that. Also, there is one more factor now. The global paper prices are very good. So in fact, my NSR of the export is also fairly healthy. So in fact, there is an incentive to export as well today. This is one scenario. In fact, the TNPL also export a good quantity. Trident also export a good quantity. So there is an export from India. It is a copier paper or a writing printing paper. That's on the export front. But the import is fairly now, we are very competitive. In fact, our prices are lower than the landed cost of imported paper today. So, I mean, that goes in favor of the industry now.
You know, there is a report, I think this is Investec, a broker basically, who covers your stock. And they have a 220 odd rupee target price on your stock. And they expect profit growth to be 30% over the next 2 years, this year and next year. Sounds all right, or I mean, would you want to come in with some numbers?
See, the first quarter you have seen a growth of 60%, right? And when I was commenting on the result and the outlook also, I have said few of the things that the cost drivers and the cost levers are in favor of the industry today. Also, because of the robust demand and the global paper prices, the price scenario is also favorable to the industry. So, I mean, I would certainly say that the profit trend is going to be what you have seen in the first quarter, barring few hiccups here and there.
What could be a hiccup which could become a bit of a problem, bigger problem? I mean, what should we watch out for really?
See, the hiccup, okay, so the hiccup, I would say that in the short term, if the coal scenario, the coal supply scenario, if this is disturbed, then I mean all the paper players will have to depend on the imported coal, which is fairly, I mean the cost wise it is much higher cost than the domestic coal available from the Coal India. So that's one factor. The second factor can only be, and that can only be that if the international paper prices radically goes down, and if there is an import pressure, then there can be one more scenario. That's all. These are the two factors I am saying that those can create hiccup in the profit growth.
Let's head across to the Axis Capital Conference. So that's underway in London currently. Kashyap Pujara joins in from the sidelines. Hi, Kashyap. Thanks very much for joining in. Let's first, in fact, start off with macros because that's how the markets are reacting now to the challenging macros, rising crude, weakening rupee. What's your call on the outlook for the entire macro set of indicators, and how do you think the market will react from here on?
See, macro is clearly a challenge. It's a headwind which has been there. The rupee going to 71 and beyond is definitely a challenge, and a bit higher than what one were accustomed to. Having said that, one needs to keep in mind that we are in an inflation targeting regime, and it will be over to RBI to, how they basically, rein in the inflation expectations, which would eventually, over time, make the rupee come back to its fair level. So even though, it's gone beyond the threshold in the interim, we are of the view that, things will improve and rupee would broadly settle down in the 70s kind of range and not, depreciate further from here on. In a sense, our expectation is that, the commentary could be a bit hawkish, and it is likely that we might see, a couple of rate hikes through the year.
Okay, so if your take is that the rupee is going to stabilize around these 70-odd levels and not depreciate further, in that case, do you think most of the rally in export sectors like IT and pharma is played out, or do you think there's still some more steam left in these stocks?
Structurally, rupee depreciation is a tailwind for them, but one will have to see, which businesses, when it comes to exports, have sustainable demand drivers and not just a tailwind of rupee depreciation. See, rupee depreciation per se, purely from a perspective of the inflation differential between, say, a USD versus the Indian context, would in a way depreciate 2-3% per annum purely on the basis of the inflation differential that we would be at. But that apart, one should actually see the structural drivers of demand and from the export side, and see how the competitiveness is, and then take the call rather than purely a INR depreciation call. On the IT side, we clearly see, the first quarter going on the right note, at least beginning on the right note. We do see the top tier companies, which will be able to demonstrate 6 to 8% constant currency kind of growth. We are seeing deal sizes getting larger, and the tailwind of rupee depreciation will enable them to reinvest some of that into building further capabilities. So we do see IT to be in a good pocket even now. Pharma, we are more, domestic pharma driven. We feel that, it's very difficult to forecast how things are going to be when it comes to exports to US. But the domestic pharma side is more like a consumption kind of a play. Valuations are reasonable, and we can see demand sustaining for quite a long time. So our preference is towards more domestic focused names in the pharma space.
Kashyap, on consumers, I know that you're positive about and confident of the earnings growth there, but more and more noise one is hearing about valuations. They've always been high, but at some point it starts to matter, and I guess that's now. Stocks are down between 8-10% from their recent highs. At the conference, are you hearing that sort of worry about valuations being far too high?
We feel that, large part of this earnings growth is already priced in most of these stocks, because if you look at staples, it's no longer about absolute investing. It is only about relative investing as to who is cheaper versus the other, but it's not about absolute investing altogether. In fact, the IRRs that one can expect on these stocks at the current point in time are close to single digits, which means that markets are actually looking at a very low discount rate that there is no cost of equity or very low cost of equity for these stocks. And many of these names, even if you were to take a call that in 4 years or 5 years that top line doubles with expansion of margins, even 4-5 years out, they are still looking like 25 times or thereabouts. So valuation is clearly a miss, and that's why we feel that one will actually have to be a bit more picky and, and maybe look at companies a bit more differently rather than looking at the same favorites.
Fair enough. Kashyap, any other space, that you think is going to outperform, any other space, any other theme really that you find attractive from an absolute investing perspective, because as you said, many are now just relative investing plays.
If you broadly look at the recommendations which were made in the report, they were largely based on underpenetrated stories. So when you are mentioning the India Energy Exchange, again, that is clearly, the power trade that traded through the exchange is extremely low from a penetration standpoint, and that's been seeing growth. If you look at business services, we are quite optimistic on business services, be it the staffing business or the facility management or the security services. Again, those spaces are really fragmented, unconsolidated, where few leaders are in a position to consolidate the market and continue to grow at a high point. So we are very optimistic on that one. When you look at pharma, the name you just mentioned, essentially it's a company with high return on capital, no debt, growing consistently at a high point. So we feel that the domestic names are more, domestic pharma stories are more like a proxy to staples in a sense, because they are consumable, consumption based stories, but in the pharma context. And we feel that the valuation is comparatively substantially cheaper to what you are paying up for a staple. And the growth profile of these companies are better than what you actually get from staples. Whereas the return on capital employed is reasonably strong. The profile is free cash flow. So essentially we feel that these are the stories which we would be placing our bets on.
Kashyap, thanks very much. Have a good conference. Appreciate you joining us here